Farms.com Market School with expert commodity analyst Moe Agostino is an online educational video series designed to help you, the farmer, improve your knowledge of grain marketing. Farms.com Market School is brought to you by DeKalb Brand Seeds. DeKalb, growing confidence. In today's video, we are explaining and defining many of the industry jargons and terminology that you constantly hear if you go to trade shows, seminars, presentations. Maybe you're reading an article and you just don't quite understand what they're saying. By understanding the most common industry jargons and terms, you'll be able to understand what it all means and how it applies to your marketing plan. So let's start off with, and this is all alphabetical, so at the money call or put options. What the heck's an at the money call? We've covered, again, a lot of this in a lot of the videos we've done. We've got a total of 30. So at the money, when the exercise price of either a put or a call option is the same as the market price of the underlying asset. So, for example, the futures price of corn is $4.50, and at the money call or put option is $4.50. That's your strike price. That's an at the money call or put option. Backwardation. It's an inverted market in grain market terminology where the nearby contract is priced higher than the first deferred contract. A backwardation that is getting larger, wider, indicates commercials are becoming more bullish, most likely because supplies are tight and prices need to move higher in the near term to ration demand. While a smaller or narrower spread means commercials are becoming a little bit less bullish towards that neutral area. For example, backwardation would exist if the March contract for corn price is $7 a bushel, the May contract is $6.95, and the July contract is $6.90. So again, the front months are higher than the deferred months. Basis, the difference between the cash and futures price. That's all you need to know. Everything else, local supply and demand, currencies, transportation will also affect your local basis. Bearish, the expectation that prices are going to go down. So sometimes you hear them say bearish versus bullish. Bearish means you expect the price to go down. Breakaway gap, we talked about this in the technical analysis part 1, 2, and 3. A chart formation in which prices gap out of an area of congested trading, often signaling the start of a major move. What follows are runaway gaps and then the exhaustion gap. The exhaustion gap is the last gap signaling the end to a down or upward trending market, and that's when you start to pull the trigger and call the top. Bullish, the expectation, the opposite of bearish, the expectation is for future prices to rise. Buyback, closing out a short hedge by buying the previously sold futures back. So maybe you sold futures on corn in 2012 at the record high at $8.49. And when it dropped to, let's say $5 a bushel, you bought that position back. You offset it in order to offset a physical sale because you ended up delivering some bushels, harvested bushels to your local elevator. A call option is a contract gives the buyer the right but not the obligation to establish a long futures position at a specified price known as the strike price by exercising the contract. Very seldom do contracts get exercised. The buyer pays a premium for this right, and this premium is the maximum loss that you could be achieved until the decision to exercise that futures contract is made. Remember, it's the opposite of futures contract. Futures contract, you have margin money. If you spend $1,000 to buy a call option or a put option, that's the maximum loss. For example, a livestock producer could buy a call option to protect against an unexpected price increase in feed costs such as corn or soybean meal. Cash crop producer, on the other hand, could buy a call option after making a physical sale to keep himself in the game in the event that prices move higher. In either case, if the price falls, the call option would expire worthless, but it would benefit the livestock producer with cheaper feed. That cheaper feed, he would be spending a lot less money buying that feed as opposed to what he invested in the call option. And the cash crop producer, the initial cost would be subtracted from the net price of that physical sale. So he spent 20 cents to buy that call option. He sold corn at $5. His net would be $4.80, 5 minus 20. Carry, the price structure of a particular market when contracts trade at a progressively higher level. The first deferred contract is priced higher than the nearby contract. The carry is influenced primarily by supply and demand conditions and is indicative to producers or commercial elevators to hold grain for future use. We covered carry in our basis video. The market is paying a producer to store its grain. So when you get a carry in the market, so the deferreds are higher, and it's covering all that storage, insurance, interest cost, you got to take advantage of that. Carrying charges, the cost of storing a physical commodity over a period of time, including insurance, storage, and interest on invested funds, as well as other incidental costs until it is sold or delivered, which I just talked about. It is a carrying charge market when there are higher futures prices for each successive contract month. If the carrying charge is large enough to cover the costs, it's called a full carry. Cash market, a market that allows the seller to make a delivery of his goods or services and receive that day's price. Commercial, an entity involved in the production, processing, or merchandising of a commodity and has an underlying cash position that is using the futures market to hedge against, for example, a grain elevator or an ethanol company. CME, Chicago Mercantile Exchange, is the world's second largest exchange for futures and options, such as agriculture products, and the largest in the U.S., trading involving mostly futures on interest rates, currencies, equities, stock indices. CFTC, Commodity Futures Trading Commission, is a group that monitors positions of the various market traders like the speculators, or there's the index funds or managed money. Contango, a market, this is the opposite of backwardation, a contango market where the forward or futures price is higher than the spot price. The first deferred contract is priced higher than the nearby contract. A contango that is getting smaller, narrower, indicates commercials that are becoming more bullish, while one that is getting wider indicates commercials are becoming more neutral or bearish. For example, contango would exist if the January soybean futures contract price is $9.80, March is 10, and July is 10.10. For commodity futures contract, contango markets considered normal, as there's typically a cost to carry or for holding that commodity. Dead cat bounce, a brief recovery from an extended oversold decline or fall in prices, also known as the bear market. So for example, 2008, corn prices went from $7.50 down to $3.05 within quick order. That's a oversold market. When you get to that 305, you potentially get a dead cat bounce. Deferred contracts, future contracts for months beyond the nearby months or spot month. Deliveries, future contracts that are held into the delivery period are subject to delivery. This means that those holding long positions, long futures contract, will be required to take delivery of actual cash grain in one of the designated delivery locations, while those holding a short futures position will be required to deliver grain to a designated delivery location. Forward cash contract, a cash market transaction in which a seller agrees to deliver a specified cash commodity to a buyer at some point in the future. So we've talked about this before many times. That's what I want you to focus on. You're selling some bushels to your local elevator. That's a forward cash contract. You either lock in the futures or the basis or both. It differs from a futures contract in that the contract size, product specification, delivery date are set between the buyer and the seller, not standardized by the exchange on which they are traded, and the price is also negotiated at that time. First day notice, the day that the futures contract delivery process begins. Long position holders who maintain their positions on and after first day notice, usually at the end of the month prior to the following month of a futures expiration. So usually it's around the 28th of the month. So if it's a July futures by June 28th, you need to make a decision. If you're a farmer and maybe you locked in the basis, you have to either flatten out that contract and lock in the futures or roll forward. So that's what we're talking about, first day notice. For farmers, you got to understand that once you get the first day notice, you either flatten out the contract or you roll forward. For example, December corn futures will expire around the 15th of December, so the first day notice again is around that November 28th. So understanding some of the most common terms used in the commodity market can help towards executing a better marketing plan. Knowing how your industry operates is half the battle. The other half is understanding the industry jargon that is usually only for professionals who have studied commodities for years. This new understanding and knowledge can give you one leg up on your marketing plan.